Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said, "Millionaires don't need astrologers, but billionaires do." And so we begin. Today we'll start with the Bitcoin chart. This is each candle represents one day. We had a bit of a breakout to a high. Someone I follow, one of the most respected traders out there right now, Gareth Soloway, has been saying on his channel that we are at a major resistance point here and that we could go back down to the bottom of a channel, but if we break above it, it could go higher. And so I don't like to play around with this level. I don't know if Bitcoin's going to go up or down here, but it was interesting that we had breakout to the upside here. Next chart, S&P 500 on the daily. If you take a look over to the left side of the screen, you can see the high was at 4,999.89, which means we were 11.11. I don't think that might represent cents, but it's not really. I don't think so. But 0.11 away from that even number of 5,000. People shied away from it. 11, we'll call them cents. 11 cents below that big number. So the big question is, are we gonna blast through are we gonna blast through this thing tomorrow? Is that possible? Are we gonna sit here for a while, play around with this number? Let's take a look at the crystal ball real quick. I have no idea. I think, actually no. If I look in my crystal ball, the truth is the economy is strong. Everybody's basically doing fine. We haven't started that cycle of everybody losing their jobs and the yield curve uninverting because everyone's losing their jobs. I mean, usually, we're not at that part of the cycle yet, and so we can still go up here. To support this view, my favorite chart to look at is high yield corporate. Again, these are risky bonds, and it just means that, again, this fund represents how much people are willing to bet that higher risk companies are not going to go bankrupt. And this is it's not at a cheap price right now, from relative history preceding where we are today. This is a daily chart, and as you can see, this thing is just comfortable here. One thing, if you see this thing collapsing, it's a pretty good sign that the stock market is going to soon follow. To clearly illustrate this, here is comparison. The blue line is the S&P 500. These bars down here are high yield corporate. Now, as you can see many times, when this thing starts breaking down, you can see right here, for example, the S&P 500 doesn't seem to care all that much, but the high yield corporate, smart money and more risky bonds is starting to see a little bit more risk. And what happens? The S&P 500 follows. Again, there's a few examples of this happening. One right here where we see, high yield corporate collapsing. The S&P 500 is not collapsing yet. Here we have a consolidation pattern on these candles here, all while the S&P 500 continues to look like it's consolidating before it finally moves several days later after high yield corporate starts to sell off. And this is my favorite indicator as far as trying to keep track of what might be happening in the immediate future. All right, and then on the VIX, I just wanted to point out the major fear gauge index. This represents call and put options. How fearful are the gamblers basically in the market, and we're hitting this trend line here, which it's hit it several times, and so we could actually break through this here to the downside, which gives even more weight to the idea that the S&P 500 can continue moving higher. As you can see in the CNN greed index, we've crossed back over into the extreme greed category, whereas yesterday we were in only the greed. A week ago greed, previous close greed, Again, a month ago was extreme greed. We dipped into the greed, now we're back into the extreme greed. So pedal to the metal for investing, I suppose. Now, this is the next chart I wanted to go over real quick. This is the 30-year bond yield, treasury yield. We have a flag developing right here, which I find interesting. So when you have a move up, let's doodle that. Doodle up and then a flag. Typically we see that move again here, and then that would break this trend line here, which to me appears to be a pretty good head and shoulders. And so for that reasoning, I do still think that we're headed up to that range of 4.7 to 4.8% yield on the 30-year bond, and that's when I will be participating. I'll be probably putting about an additional 10% of my portfolio in at that time, for no other reason than that yield is it's higher than almost any stock you can get, and it's guaranteed for 30 years. It's very low risk. The only risk is if this keeps going up, then the bond fund will the value of the bond fund will go down. But you know, the overall, I believe there are heavier disinflationary factors than there are inflationary ones, and I think as this yield going up into this range or even higher is an error. I think it will be collapsing within a year from right where we are. So I'm going to say before 2025, if I look deep into my crystal ball, before 2025, collapse in yields on the long end of the curve. Here's the 10-year. It's doing the same exact. It's pretty much the same chart. We have this bull flag right here. A lot of people like to use the 10-year as the longest duration treasury yield that affects the economy the most. That's why everyone always talks about the 10-year. They don't talk usually as much about the 20 and the 30-year. What's more exciting about it for me is the extra leverage you get with the extra duration. Last chart of the day, K-Web. I had said yesterday that I was surprised that we hadn't blown even higher in this fund, and you know, we sold off a little bit today. My crystal ball rating is saying that profit taking here. Some people that may have gotten in at the very bottom of this might be selling their very nice gain that they would have gotten in a very short time period. And that's all I have for today's show. I hope you enjoyed, and thank you for watching. Robschild.